Well, hello, you trader nerds. Hope everybody's doing good today. It is, what day is it? It's Wednesday. I hope everybody's having a wild, wild Wednesday. And real traders never trade alone. They trade with their fellow nerds like Carlos and Charles and DB and Donnie and Dwayne and Edwin and Hal and Hugh and Jason and Jim and Matt Jollywally and Mo and Notional Ed and Ricardo. Ricardo. I can't do the roll of my R. Ricardo. Stacy, Steven, Stuff, and Victor. Hey, everybody. Glad to see you with us today. And we are having a wonderful, wonderful time. And someone said that my YouTube channel has gone to crap. And that may be the case just because, I'm not doing the 111 or 112 anymore. And I know that was probably a very, very, very popular trade. I just can't, in all good conscience, go back into that trade knowing what it did to us on August 5th. And a lot of people said, Bobby, it's a one-off event. And it is a one-off event, but it could happen again. And I'm not going through it again. But some of you are saying, well, yeah, but what you're doing now is very risky too. And you could easily be down 50% with the new strategy. And you're exactly right. You're exactly right. But I think the difference between the option strategy and the holding of an asset strategy is basically my belief that the American economy through the stock market will recover. It will. And so if I'm an asset holder, I think that will eventually go up. And plus, we've got the Black Swan hedge in it. So my actual, and this is going to sound like blasphemy, me saying what I'm about to say, but I'm not certain that you can consistently make money with options in the with uh, shorting premium. I'm not certain of that. Just not certain. We had a couple of good years there. We really did. And then to have it, really destroyed in one day was just something that I'm not going through again. Just not doing it. So that's my take on it. And I have to be as transparent as possible and tell you what I think and what I'm going to do. So the basic thing is that I think that if we hedge with options, that's our best bet. I think that options provide a great hedging mechanism, and that's what we're doing is we're hedging a otherwise long equity account with options. So that's where we stand. So let's look at the market today. The ES is up 7.5 points, 0.13%. Volume looks a little low right there, doesn't it? And everybody's off for lunchtime chop. Get their Subway sandwiches, which Subway sandwiches are high now, y'all. And I'm gonna tell you something. You'll never eat another Subway sandwich if you ever have a Firehouse Subs. If y'all have a Firehouse Subs where you're at, and you try that, you'll go, "Oh my gosh, Subway is nasty compared to Firehouse Subs. Firehouse Subs is good." VIX is 18. AD is negative 29. That's interesting that AD, the advanced decline, is negative while the market is up. So we may see a little bit of foreshadowing with the market today with the AD being low. Let's see what the big green monster looks like. Big green monster. Let's go to volume profile. And ES is fairly priced. It is at its point of control. Everyone asks, what is the point of control? The point of control is where the most volume has traded over the last 10 days or over whatever time frame that your chart is set up for. But mine is set up on a 10-day, 30-minute chart. And so for the last 10 days on a 30-minute basis, this is where the most volume has been traded. And we are right there. So this is very, 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 very good because we think that this will serve as an area of support. It actually has for a couple of times now, and it bounces off of that. And it's probably to a point that we're going to go to the 58.67. That's probably where we're going with the market. Now, we can confirm that though by looking at linear regression, and we go to linear regression, and linear regression is still in a consolidation mode. So remember, what markets do is they go up or down, then they consolidate, and they either continue the trajectory that they were on or they change the trajectory. And you see this happen over and over and over again. So we were in an expansion where we went up and the overall market is going upward, but now we are in a little bit of consolidation. And the consolidation will happen, and then the market will make its mind up if we're going to go further up or further down. So we're still waiting on that confirmation to see where the market goes. All right. So let's look at our little account today. And I did some further um, I did some further research on the optimized strategy and basically came up with some different things, and it's really neat, the different things that Claude is recommending to us and everything with the portfolio. But we did some scenario analysis, simplified backtesting results, and kind of came up with an optimized strategy. Now, I know what you're saying, Bobby. You're looking at historical data, and what you are doing is overfitting that uh, back testing with the data that has happened in the past. And there's absolutely no positive way that to know that this thing will continue into the future. And you are exactly right. So what we did here is we did some simplified back testing results. So initial investment of $100,000 for each period. And it basically did from 2010 to 2024, the further enhanced, and I hadn't showed you the further enhanced strategy that we came up with from yesterday. There's been a few changes, and I'll go over those, but I just wanted to show you what the Claude basically came up with some simplified back testing and some different results. So from 2010 to 2024, the strategy, the TQQ strategy, had an annual return of 35.36%. The max drawdown was 37.18% with a Sharpe ratio of 1.55. Now, if we look at different basic time frames, it basically said, hey, let's look at different time frames, right? So from 2010 to 2014, which would be what, 5 years altogether? 2010 to 2014, this thing had a 33.89% and a max drawdown of 28%. And the Sharpe ratio was even higher. And remember, for those of you that deal with Sharpe ratios, the Sharpe ratio, the higher, the better, right? So this still maintained a really good Sharpe ratio from this period here. Then if you look from 2015 to 2019, which is another 5 year period, it was up 31.45%, and the max drawdown was 22.76% with a Sharpe ratio of 1.48. From 2020 to 2024, it had an annual return of 41.12%, max drawdown of 37%, and a Sharpe ratio of 1.53. Now, what's interesting about this is look at this. This is from 2020 to 2024. This was the worst time for the strategy was 2020, and it has, over this 5 year period, has returned the most return, which is really interesting. Although the max drawdown was the greatest, really. So it tells the entire strategy, the max drawdown happened during that time was 37.18%. So the strategy has shown strong performance against different time periods. The highest annual return was achieved in the most recent time periods. We included both the COVID crash and the subsequent recovery. The maximum drawdown was highest in 2020, 2024, likely due to the March market crash And as I indicated, the Sharpe ratios remain consistently strong, indicating good risk-adjusted returns across all periods. And then what we did is we did a scenario analysis result. So basically, it looked at this thing in different scenarios. And it looked at it in a bull market of 2013, and the strategy returned 46.92%. Jersey Mike's is even better than Firehouse Subs. I've had Jersey Mike's. I don't know if I'd say it's better. It may be as good. I don't know if it's better. But now I'm wanting a sub. Way better, Carlos. Okay. Matt says not better. Okay. So in a bull market, this is going to do really, really well. And then it basically compared it to if we had done an S&P 500 return and 32.39%. So our strategy outperformed the S&P 500 by 14%. Then it looked at a sideways market. So this was the year 2015, and it returned 22%. Look at this, y'all, in a sideways market, where the S&P only returned 1.38%. So the strategy outperformed by 21.18%. Then it looked at a very volatile period, which was the quarter 24, looks like a single quarter, which was a very volatile time. Strategy return was negative 8%, whereas the S&P 500 was down 13%. So we outperformed in a very volatile period as now. Now, what's this? This is kind of cool, y'all. The strategy in the COVID crash. Now, this is really, really good. What was the max drawdown versus the S&P 500? Let's see. For the simplified, I don't know if the simplified showed it or not, did it? Let's see. No, that didn't show it. Let's see. This scenario basically, well, here it is for the COVID crash, right? This would be the max drawdown for an S&P 500 thing. So the strategy of a max drawdown was 37%. And remember, the S&P 500 was down around 35% or so, which is confirmed here. So the S&P 500 was down 33%. So even though we were in leverage, okay, it is saying strategy. So this includes the hedge portion. No, Stacy, it does not. The AI is aware that I am doing a hedge, but it doesn't figure that into the thing. So this is without the hedge. So we would have been much better here with the hedge compared to just a 100% S&P 500. Yeah, it's just TQQ and TMF, Stacy. That's correct. So we would have been down 37% while the market is down 33%. So that's very robust too, right? So that's really good. Post-COVID recovery from April 2020 to December 2020. Look at this, y'all. Our strategy was up 82%, and the S&P 500 was up 47%. So strategy outperformance was 35%. So the strategy outperformed in bull markets and sideways markets. It provided some downside protection during volatile periods. The strategy experienced a slightly larger drawdown during the COVID-19 crash, but recovered strongly. So can you live with this worst case scenario? Now, it could be worse going forward, no doubt, but a 37% drawdown, could you survive that? I think so when we have our hedges in. And I think we could do that. So that's kind of cool. So then it did a rolling returns analysis. So let's look at that. Rolling returns. So average rolling returns on a 1-year basis, it was 33% compared to S&P 500, 13%. A 3-year time frame, the strategy was up 98%, whereas S&P was up 46%. 5-year rolling strategy was up 189% compared to the S&P 500, 78%. So you can see we clearly outperformed a 100% S&P 500 thing as well. So percentage of positive rolling periods, the strategy in 1 year is 87% compared to 83% of the percentage of positive rolling periods. So 3 years, 94%, 91%, and under 5 years, all 5 years, the strategy was up one, all possible 500 rolling periods. The strategy was up all the time, and the S&P 500 was all the time. So the strategy consistently outperformed the S&P 500 across all time frames. The outperformance increased with longer time frames, suggesting the strategy benefits from compounding effects. Strategy had a higher percentage of positive periods for 1 year and 3 year rolling returns, but both the strategy and the S&P 500 had positive 5 year rolling returns in this period. So then it did a sensitivity analysis, which was really cool. I thought you'd like this. So basically, it said, hey, what if we the original strategy we have, remember, is 35% annual returns, and the max drawdown was 37% with a Sharpe ratio of 1.55. So then it basically comes in and says, hey, what if I change the thresholds on VIX, right? So it basically lowered the thresholds on VIX and it got up to 36%, but a max drawdown. So that's worse. Higher thresholds of VIX, it was 34%, max drawdown of 35%, and a Sharpe ratio of 1.57. So then it changed the trend indicator periods. It used shorter periods, an 8-month SMA and a 8/16 week EMA. So it basically changed all of our triggers to see if it could maximize. And basically, the strategy that it eventually came up with appears robust to minor parameter changes. Lower VIX thresholds and more aggressive allocations increased returns, but it also increased the drawdowns. Higher VIX thresholds and more conservative allocations reduced drawdowns, but also lowered returns. So basically, the AI came back and said that the base case seems to offer a good balance between returns and risk management. And I basically wrote back to Claude and said, Claude, I said, based on what you've shown here in the sensitivity analysis, it appears that what we've come up with is probably the best case scenario. So let's go back up and see if we can do something else here. So I asked it if it could do Monte Carlo simulations, and it basically told me how we could do that, but that it could not do that. And so that's why it came up with the simpler back test that it was able to perform on our basic structure. So then let's see here what we did here. This is kind of cool. Okay, so I did tell it that we had a black swan hedge in place, and it said combining the strategy with the black swan hedge is a smart approach to portfolio management. It potentially provides significant protection during market downturns or unexpected events. It is a great complementary strategy. It told me that. Potential for asymmetric returns. Well-designed black swan hedges often have the potential for large payoffs during market crashes. And psychological benefit, knowing that you have downside protection in place can make it easier to stick with this strategy. So the AI knows that the strategy that you and I or anyone that's doing this is implementing is going to be a little bit difficult to hold into during those big times of market stress and market volatility. So this should allow us to stay in the game. Tailored risk management allows you to more finely tune your overall risk exposure. And what we will keep doing is we will continue feeding the data from our returns and the historical data of TQQ and TMF. We will continue to feed those numbers into the AI here, and it can further refine our strategy, right? So this was kind of cool telling it that. So let's see here. I'll run a back test of our simplified plan using the historical data provided and give you the results, including the yearly CAGR from 2010 to 24. So again, it achieved a 35.36% return over the back test, which significantly outperformed a traditional stock bond portfolio. It showed consistent growth and was even positive in most years with only one negative year during the backtest period. While the strategy uses leveraged ETFs, the maximum drawdown of 37% is relatively contained suggesting that the dynamic allocation helped manage risk. Market adaptation, it works well in bull markets and more challenging environments. 2018, 2022, indicating good adaptability to different market conditions. And it has continued to perform well in recent years, including the partial year of this year, 2024, which suggests it's relevant in current market conditions. With a Sharpe ratio of 1.55, the strategy demonstrates good risk adjusted returns. So it does then give you a little bit of warning, though, that hey, the back test covers a period that was really favorable for all stocks in general. So the strategy's performance in different market regimes or future market conditions may vary, and we're aware of that. We're certainly aware of that, right? So let's see what else we did here. Okay, so basically, it did come up with a version that was a little more complicated. And I basically said, hey, come to think of it, I don't want to provide you with daily VIX data every month. So I thought that if we did, you can enhance the strategy further, and it made for better annual returns and less drawdown. But it wasn't so significant of an improvement that I thought it would be worth me feeding into this every month. I didn't want to do it every month to feed in the data for VIX daily. But it did come up with a way that it improved it some, but it's just, you got to think what y'all said yesterday, keep it simple, stupid, right? Keep it simple. Don't put all these other things on there because we just want basically something that we can kind of set it and forget it and just update it monthly. So I basically then come up with this. This is a simplified method, and I'll show you that. Do y'all remember that the one that we had that we actually did yesterday took $100,000 account and it took it to $2 million in those from 2010 to 2024. Well, this plan was kind of cool because it had a better Sharpe ratio and the returns were actually $7 million. So it took $100,000 investment in 2010 and turned it into $7 million. Now, I know what you're saying, but Bobby, if back in 2010, if I had just put 100% of my money into TQQQ, today it would be worth $12 million. And that is true. If you had done that, $12 million. Our strategy only produced $7 million. But I think the drawdown with the 100% TQQQ portfolio was right at 80%. So could you have stomached an 80% drawdown on your way to 12 million? That's the question. And so that would be really, really, really tough. So I think as far as a Sharpe ratio and risk adjusted returns, what we've kind of come up with here is kind of the best. So let's just go into the plan. Now remember we were doing a 60-40, right? So it dynamically allocates between TQQQ and TMF based on a trend following and volatility indicator. So we've still got the VIX in there, it's just not the daily VIX. So the base allocation, and you start with this every month, is only 43% TQQQ and 57% TMF. So that's the base allocation. Now you could roll that down and call it 40-60 if you wanted to, which was kind of interesting that it came up with this as being more optimal than the 60-40 that we started with on the other strategy when we started yesterday. So it basically has three indicators. It has a 10-month simple moving average of QQQ, has a 10-week versus 20-week exponential average of QQQ, and it has a volatility indicator. And it is true in everything that I've been reading, the higher the VIX is, the less advantageous it is to TQQQ. So when VIX gets high, you kind of want to reduce your exposure to TQQQ as the VIX gets higher. So here were the rules that it implemented for the back test. If QQQ is above 10-month and the 10-week EMA is above the 20-week EMA, you're going to increase TQQ by 20% and decrease TMF by 20%. If it's below all of those, you're going to reduce by 20% and increase TMF by 20%. Now remember, that's actually you would go from 43% TQQ to 63% TQQ. Everybody with me? It's not actually 20% of the 43%. So you actually add 20%, not multiply 20% times 43 and then add that. You actually add 20 to the 43. If trend indicators give mixed signals, no trend-based adjustment is made. And then here's the VIX adjustment. If VIX is less than 12, increase TQQ by 15%, decrease TMF by 15%. If VIX is between 12 and 22, you're going to increase TQQ by 7.5% and decrease TMF by 7.5%. If the VIX is between 22 and 32, you decrease TQQ by 10%, increase TMF by 10%. And if the VIX is higher than 32, you're going to decrease TQQ by 15% and increase TMF by 15%. So you combine the trend-based adjustment with the VIX-based adjustment, ensure that the final calculations are within the 20 to 80% range for each asset. So I think what this is saying is that you never want to go over 80%. You want to keep your allocation between 20 and 80%. So you would never go 90 or 100% for one asset or the other. If the combined adjustments would push an allocation outside of the 20-80%, you're going to count the allocation at the nearest limit, 20% or 80%. And then you're going to do this on the first trading day of each month. So kind of cool, right? Then what we've done is we've come up with a way to dollar cost average new money in, divided into 6 equal parts, invest 1 part each month for 6 months, use the current month's allocation percentages for each investment. And then we love this. We've got a risk management here, acceleration clause. If TQQ price drops by 10% or more from the initial investment price of those installments, then you have the permission to immediately invest all remaining installments using the current month's allocation percentages. So in other words, if I put my money in yesterday and today TQQ was down 10% or more, then I could certainly go in and say, hey, that's a good way to buy in. I could take the remaining 5 installments and put them in together. Okay. Let's see. Risk management. It says set a maximum drawdown threshold, 15 to 20%. That would trigger an immediate reduction in TQQQ. I really don't do that. It says consider implementing a stop loss or trailing stop for the overall portfolio. That's probably a little more difficult to institute on an ongoing basis. Probably not something I do since we do have the hedge in place. And track monthly and cumulative returns. Calculate key metrics going forward, and regularly review and update the strategy's parameters if necessary. And then it gives the little warnings. It says, hey, Tubby, hey there, oh Bob, oh Bob, oh Bob. What you're doing is extraordinarily risky. It has significant risk, and it's not suitable for all investors. And I would say that goes without saying that it's certainly not something that everybody should probably do. But could you do this with $10,000? Well, sure, you could do it with $10,000 and just test it. So if you've got a $300,000 account, don't throw in the entire $300,000. Maybe do $10,000 or $20,000 to the strategy if y'all want to follow along with it, which I think would be kind of cool. So basically, this is the simplified plan. So let me now copy this and paste it in as the new plan. And if y'all need this, just let me know and I can get it to you. So I'll copy that. We'll go over here. And let's see, what is this? This is the TQQ trading strategy. Here we go. So we'll delete all this. I'm just taking all that out just in case I don't have the most current here. Let's delete this and put the new one in. Yeah, this one was a little bit more complicated by having to give the VIX numbers daily. I just don't want to do that. So let's do this. And then it created a prompt. And the prompt is over here. Let me show you this. Basically, at some point, this conversation with Claude will have too much information in it. And I wanted to make sure I could go to Claude on a new conversation, and new conversations do not remember old conversations. So I needed basically a way to go into Claude and say, hey, Claude, we've got a, they're not showing my thing here. Let's copy it here. Here we go. Use the following prompt for monthly allocation status. So let me copy that. And let me go monthly allocation prompt. Allocation prompt. And then I'll basically show you how the prompt works, right? So there you go. That's interesting. Now, so what you could do is, so if we're going to do, let's see for the back test results of this are. Making strategy more robust. Let's outline a plan to further optimize use market civilizations. 1, 2, 3. That's not it. Where are the back test results? See if we could find it here. I wanted to show you. There we go. Let's see, allocation adjustment rules. That was a little bit. And it's cool though. I mean, I like this. And I'll kind of show you how this works. VIX data analysis. I send them. That's when I give them all the VIX numbers. Yeah, and this was kind of cool. I basically went in and said, "Hey, we already did it the old way, right? We didn't do it this new way plan." And so it kind of came in and said that I should sell 17 shares of TQQ and buy 21 shares of TMF to get to this correct adult. So we may do that. Let's see. Where's the back test results? Just wanted to show you all that really quick. Let's see. Here's where I gave it VIX. Well, nonetheless, we may stay a little later and after school, and we'll get it to run the back test. All right, y'all. So that's what we've got. Hope everybody has a great day. I will see y'all tomorrow. So let's stop recording.